All right, so moving to slide 54, I'm going to just jump straight into a numerical application, a numerical example of using this approach to pricing, and we'll build up a fair bit of theory as we pass through. So first, again, the fundamental equation that we're looking at is that the price of something is equal to the expectation of the stochastic discount factor multiplied by the cash flows, conditioning on any information we have. So starting with the simplest case, let's start with the situation where we say that we are uninformed. That is, that we have no information at all. And so I'm going to focus on this column here because in this problem that I've given, the information that we could attain pertains to the probabilities. Okay, so we have two sets of probabilities here, and it's in the uninformed situation that we're going to start. Bear in mind that in an exam setting, it could be the case that the information I give you could either relate to the stochastic discount factor, or it could even relate to the cash flows. And so what would happen is the numbers that you're changing, depending on information, may itself change. It won't always be affecting, in this case, the expectation. It could also be that Z modifies M or X, or maybe even a combination of the two of them. And so, let's just be conscious that I'm starting with something I think which is a simple situation, but I could modify it slightly in an exam setting. All right, so here let's start with us pricing Google uninformed. And so you'll notice that there's no Z tilde here, no Z, conditional Z information. And so we're going to take the expectation. So these are the probabilities. 25% comes here. The probability here is 45%. And this probability of 30% comes here. And then we have the pricing kernel, which for the moment, just accept it as a number. I'll tell you where it's coming from momentarily. So the associated M's go like this. So here we have a 25% chance of a boom. If there is a boom, the pricing kernel is this. And then here we have pricing kernel of 97 cents for the case of a steady state, and a pricing kernel of $1.02. And then I know we're getting a little bit sloppy here. I'll just switch ink color maybe so we can track. But here we have the cash flow for Google in each of these associated states. So here we have like this. And of course, the way I present this data, it may sometimes all be in a single table. It could be split over a few tables. Sometimes the probability might be written out. But if you conduct this calculation, it's simply going to be probability times the discount factor times the cash flow plus the next probability times the next discount factor times the next cash flow, repetitive. And so what we arrive at is that the uninformed player will believe that Google is worth $27.40. Okay? Now, let's compare that to a situation of the informed player. Okay, so clearing my space a little bit here. What we're going to do is we're going to have an informed player who has some information, and in this case, I've said that it relates to the probabilities. And so what we can imagine is that the informed player has some kind of little box, for example. We're going to call this the signal box, and that this signal box has a little light on it, and the light can be one of two colors. It could be the case that the light is red, or it could be the case that the light is green. Okay, and so depending on the color of the light, the player will, the trader will have a sense of whether or not they think things are good or bad. Now this box is not perfect. You'll notice that in the case of a boom state, for example, the uninformed player thinks that that happens 25% of the time. Where would that number have come from? Very possibly from looking at historical information. So it could be the case that they've said, look, in the last 20 years, we've had 5 years in which there's been a boom. And so just taking 5 over, or let's say 5 years over the last 20, then we could say 25% of the time we've experienced a boom. So that might be the case of the uninformed player. The informed player says, well, depending on my signal, it's actually conditioned. It could be the case that when the signal is green, we observe a higher likelihood of a boom, namely 30%, and when the signal is red, we observe a lower. Okay, and so what's happening here is the probability is being shifted to account for the fact that this is the signal gives you some information about what situation you're coming into. Notice a green signal, right? A good signal does not guarantee a boom. This is important. I don't want you to think that this is a perfect, indicator of the future. We have no crystal balls. What this is doing, in a sense, is it's just giving you a likelihood adjustment. So, for example, if we had a good jobs report number for the market, let's say in March, that would be pleasant. I'm not sure we're going to see that, but let's say that was the case. then it would be reasonable to assume that that's part of the many signals that we would get that would give us a confirmation that the economy is going to do well. Although if we have, let's say, a good jobs report number, but maybe a problem with the banks, we had a large injection by the Fed, I would read that as a bad signal. Then maybe the combination, would give us a different sense of if we think we're going into a boom or not. And so point being is these signals are not perfectly informative, but they do adjust your probability a little bit. So how would that apply? Well, how do we do the calculations in this? Here we have a situation where the signals can attain one of two values. They can either be high or low. What I was saying is green or red. And so we now have two possible prices that could exist for the informed player. The informed player says, I don't just see Google as being worth $27.40 for a share. It actually depends on the situation that I think I'm encountering. If I believe the economy to be doing well, that is, I get a Z high signal, then what happens is my probabilities get modified. So instead of seeing a 25% chance of boom, I see a 30% chance. And instead of seeing a 45% chance of steady state, I see a 50% chance. And instead of seeing a 30% chance of a bust, I see a 20% chance of bust. And so when I grind through this, what's happening is conditional on receiving a high signal, I actually think Google's worth $30.09. If instead I had received a low signal, then these probabilities would have been applied and I would have seen it as being worth $24.72. So imagine you have your two players, right? Player 1 and player 2 who are trading with one another. Player 2 here has a box that gives them a signal, which is private. They are not going to show it to the other person. There's, in a sense, they alone get to see the signal. And they see that the signal is green. And so what will happen is this player will believe that the price of Google is worth $30.09, whereas this uninformed player will think the price of Google should be $27.40. Okay, and so what would happen is we could predictably say that this player would become the buyer of the stock. And why? Because they're willing to offer a price higher than what this individual thinks the stock is worth. And so they would become the buyer and this individual should become the seller. Now the question is, at what price does this transaction occur? These prices that they have here are in a sense their internal evaluations. This person thinks it's worth $30.09. This person thinks it's worth $27.40. But what does it trade for in the open market? Well, we can't be entirely sure of that just yet. What we do know is that the range has to be between these two values. It has to be the case that we're looking at a trade occurring in this space. Why? Because if the sale, let's say we propose a price above $30.09, suppose we propose a price of $31, the person who's informed, although he has received a positive signal, he does not perceive that the stock is worth $31. Even given a good signal, it's only worth $30.09. He would not be willing to surrender $31. So values in excess of $30.09, these won't be possible because the buyer, even the informed buyer, even with a good signal, will not be interested. If you consider prices below 27, let's say we thought, could the trade occur at 25? The answer is no again. Clearly the buyer is highly motivated to buy a stock that they perceive to have $30 of worth for $25. There's no shortage of buyers here. The problem is the seller, even given that they're uninformed, they still acknowledge that the stock has some value, and in their estimation is the stock is worth $27 and not 25. That is, they would not be willing to sell. So above a certain price, there are no buyers, and below a certain price, there are no sellers. Right? And so the price at which the stock will move will be somewhere between these two bounds, given this, simple model. Now in practice, what will actually happen, or in many, I should say maybe not in practice, but in theory, what we'll often do is we will simplify things by saying we believe that there to be a relatively competitive market. And so in a competitive market, if this signal is good, not good in the sense of just good things it indicates the economy is doing well, but if this signal is accurate, then what we would expect to happen is that this trader would over time take advantage of people who are uninformed. And so what would happen is they would look out there in the economy and find undervalued assets, purchase those assets, gain value from those purchases. And so over time, this individual should accumulate a lot of money. And as they accumulate a lot of money, their buying or selling motive, because recall, they could also have a situation where the signal was red, in which case they would be a seller. If that was the case, they will begin to push prices around more and more than people who have smaller amounts of money. Okay, and so in effect, what will happen is the informed players or the accurate investors will be the ones who control the flow of capital and will dictate prices. And so what will happen is the price should progress towards the price of the informed player. the market price that we observe. This is what we call market efficiency. Informational market efficiency, because what is happening is the information of each individual trader, the informed ones particularly is the ones we care about, but the information of all traders is being put into the price. And so what is occurring is we are seeing that the information that this individual has begins to leak into the price. Now, if you imagine a sort of a sequential case where we have a single buyer, okay, who values it. We'll go back to the original case of well, he lost his arm, so that's okay, he'll survive. We have a situation where the individual has a positive signal and we have a few possible buyers, okay? And let's not worry about them having different levels of wealth right now. I will abstract from that for the moment because it's not really a necessary feature for what we're after at this moment. So again, given a high signal, this individual thinks it's worth $30.09, but they're going to keep this evaluation private. All of these individuals will be our uninformed traders, and therefore they will all initially think it's worth $27.40 based on their personal information. Prior to this individual, the informed individual arriving, it's reasonable to assume that the stock price will trade at $27.40 because any price other than that, these traders wouldn't be willing to trade. If it's higher than that, they'd say, okay, well, I'm willing to sell, but they'd find no buyers. If they say it's lower than that, they're not willing to sell themselves, and therefore, again, there's no transactions occurring. It's only when someone arrives with a different valuation that we can start having a trade occur. And so in this case, this individual now arrives. We get rid of this boundary that I had drawn. He shows up in the room. He says that he'd like to purchase the security. He says, I want to buy. I want to buy. Okay, and he speaks this out to the economy as a whole. And so the individual here, let's say this is the first potential seller that he comes into contact with, this person has their idea. Is this a good idea or not? Should I sell to this individual? Their concern is that the person that they're trading with, could this person be more informed? We know it to be the case that they are, but this is a concern for this individual. That concern will mean that this individual will be worried about surrendering a stock for $27 if this individual is trying to purchase it for $30.09. Imagine, for example, someone came up to you and said that they desperately want to buy your smartphone for $3,000. Or maybe a more timely example, suppose someone came up to you and said that they want to buy all the toilet paper that you have for $300. And so you would initially say, well, that's ridiculous. I don't have that much toilet paper. Of course, I'm willing to sell it for $300. But what is it that they may know that I don't? Now, in this case, of course, there's not going to be a shortage of toilet paper. We live in Canada, so it's not a problem. But to give you an example, what is happening is people are getting reticent or concerned that there may be something out there that they themselves don't know. And so if there's an informed buyer that they're interacting against, or potentially an informed buyer that they're interacting against, one way to hedge themselves on this trade, because they think it's only worth $27, recall, this is what they think it's worth, and the buyer is not going to admit that they think it's worth $30. The seller might say, will you accept $28 as a sales price? Why? Because it's worth, if they can sell it for 28 and they think it's only worth 27, if their analysis is correct and it is only worth 27, they're stand to make 60 cents against the prospective buyer. In this case, the buyer says, yes, I am interested at $28 because I think it's worth $30. And then this individual, let's say this buyer has not met all of their demand, this transaction occurs, but then the second transaction, it could be the case that this person's done selling. The next person who's available in the pool sees that the most recent trade price was $28. They see that someone's still offering to buy. They acknowledge that they themselves think it's only worth $27.40, but if it's only worth $27.40, why is it that the market is currently pricing it at $28? And so maybe if they are asked to surrender their shares, they would say, well, will you accept $29 as a price? And the answer is yes, he will still accept $29 because he thinks it's worth $30. His first share he buys at $28 and he thinks it's worth $30, so he stands to make about $2 profit on that. The second share that he purchases, he's going to find a seller who maybe is willing to sell it for $29, and the buyer still thinks that's a worthwhile deal because they're getting something worth $30 for $29. They're going to be willing to make that transaction. When we get to let's say our buyer keeps going and this person now has run out of supply as well, the second seller's run out of supply, we get to the third seller and now they see that the price has ascended quite dramatically from $27.40 up to $28, up to $29. There's still buying demand. They will say, I wonder, could I get $31 for it? Or could I get $34 for it? Right? They'll try different questions. And the answer is no, not interested. I don't think it's worth that much. And so what will happen is you can imagine that the market will eventually home in on, will 30 go? Yes. Will $30.05 go? Yes. What about $30.09? Yes. What about $30.10? No. So the last traded price will be this. That is, if the market is moving smoothly enough, what will happen is the price will ascend towards the price of the informed traders, or at least the traders who have high conviction in their evaluation. Okay? And so this is the flow of information from individuals into the broad market. It's incidentally why we think it's very difficult to compete in the market, because if you think about this as a holistic group now for a second, what is actually happening as a entire marketplace is that we are all contributing information on our trading into the price of securities. And so when we all trade, we all put into the information that we possess into the price. I'm just cleaning my board a little bit here. It's slightly easier than using chalk, but only slightly. So I apologize for the small delays. Hopefully they're not too frustrating. As I said, bear with me. If you have to skip through some of this, skip through it as you see fit. Okay, so I've got a little bit more clear space, and I think it can continue to work now. So imagine we now have many players participating in a marketplace. Okay, and they may all have different information, so there's a single price that they're observing. And so maybe this person is very bullish because of, I don't know, maybe the intellectual property rights of the company that we're looking at. And maybe this person is very bearish because of the macro economy. And let's say they're both informed individuals. It could be the case that this is an economist who's paying attention to the broad market. Maybe this is a person who is an IP lawyer who knows their job. And you could have someone who's maybe in the middle, who's maybe someone who knows their marketing well, and they're focusing on sales projections. And they say that the projections aren't bad, but they're not great, so maybe they're neutral. And so clearly this person will be attempting to buy. The lawyer will attempt to buy because they are bullish. They see that the stock is exciting. The economist in this case is a seller. This person might be sort of a liquidity provider in the sense that they could buy or sell depending on what offers they see available, because they think the stock's roughly fairly priced. And so they could switch with a little bit more information or with a little bit more demand. And so the information of all these players gets put into the price. And so why do we think it's so difficult to do better than the market? And the answer is because if you're a new person who's arriving in the room, you're not up against an IP lawyer or a marketing specialist or an economist. You're up against the entire group at the same time, because all of this information is being rewarded. If it turns out that the economist is not accurate in the long run, what will happen is the money that the economist had, he's a seller, the value that the economist had, he's sold his shares, presumably to the IP lawyer. The IP lawyer will gain more value because they have bought stocks when they're underpriced. Because they accumulate more value, the price will become more influenced by the lawyer in the future. And so the person who's the most intelligent, most accurate, begins to have ever increasing influence on the price. And so it's not to say that the economist has no influence, but maybe their influence is much lesser. And so you as a new buyer, what you're up against is you're up against the combined information of all of these individuals selecting the most relevant pieces, still including but discounting the less relevant pieces, and you think that you're going to beat this group. And that's hard to imagine, especially if we then start multiplying this and say we don't have 3 participants, but we have tens of thousands. Okay, and in that case, then suddenly it becomes quite laughable that you think you're going to have more information than everyone else. Now, that being said, it can occur, of course. There are times where the entire market ignores certain obvious information, or sometimes they don't process information well. Okay, so we've seen the numerical applications, which again, this would be sort of the first part of the problem in the short answer question on your final. We've seen the conversation about information, and the example I've given you here, again, you should recount that this is relating to probabilities, but I could have instead made it maybe about the pricing kernel.